This is Nightly Business Report with Bill Griffith and Sue Herrera.
Sell-off, a wild day ends with sharp declines as trade fears are rekindled and tech stocks tumble.
Big Blue's big bet. IBM makes its largest acquisition ever, but will its purchase of Red Hat transform this American tech icon?
No way out. Why businesses caught in the middle of the trade war with China are out of luck when it comes to getting an exemption. Those stories and much more tonight on Nightly Business Report for Monday, October 29th.
And we do bid you good evening, everybody, and welcome. Wall Street went through yet another head-spinning trading day to start this week. At the open this morning, the Dow rallied more than 300 points, and just when it looked like stocks might continue higher, the momentum started to turn, and not long after, the market's gains completely disappeared thanks to a report that the White House is preparing for the possibility of more tariffs on all remaining Chinese imports. The sell-off was so steep at one point this afternoon that all of the major indexes briefly fell into correction territory, meaning that they were down 10% or more from their most recent peaks. At the close, the Dow was down 245 points to 24,442. The Nasdaq slipped by 116, and the S&P 500 was down 17. By the way, the biggest loser in the Dow today was Boeing. It was down as much as 8% for a time, briefly dropping it into correction territory as well today. Bob Pisani has more on today's ups and downs.
Stocks staged a rally at the open, but the Dow swung more than 900 points, selling off going towards the close, but then rallying right at the close, ending down 250 points. A wild day. Early on, shares of Boeing dragged the Dow lower on news that the company's brand new Lion Air 787 jet crashed in Indonesia overnight. Aerospace stocks all in the red: Lockheed Martin, Raytheon, Northrop Grumman. Elsewhere, the stock market showed that, once again, trade issues are what really matters. Trade-related names all took another leg lower on reports that the U.S. is already planning its next wave of Chinese tariffs if the talks between President Donald Trump and Chinese President Xi Jinping fail next month. Those tariffs could amount to another $257 billion on all remaining Chinese imports. Tech was another loser today. Amazon drifted lower along with other large-cap tech names on reports that the UK would roll out the developed world's first digital tax on tech giants. The new taxes will go into effect in 2020 in the UK, expected to generate £400 million per year. That sent broader FANG stocks, including Netflix and Google parent Alphabet, lower on the day. Volatility also spiked to its highest level in 3 weeks, and for the moment, looks like the bears are back in control. 7 out of 11 S&P sectors are sitting in correction territory. That is down 10% or more off of their recent highs. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Okay, so what happens next? It's certainly something investors all want to know, and it's something that the major Wall Street firms are trying to figure out. Morgan Stanley's top strategist says the October sell-off could morph into a bear market, while Goldman Sachs says the mayhem has gotten out of hand and that stocks will rebound. So, which is it? Mike Santoli did some digging.
The brutal October sell-off has not only dropped the S&P 500 by more than 9% and pounded the majority of stocks even harder, it has also placed the market right on the line between a routine correction and a more serious and lasting setback. The sharp retreat has threatened to break a longer market uptrend that stretches back to February of 2016, when world indexes were emerging from a 6-month tailspin related to a global industrial slowdown and an oil crash. The weakness recently has investors on alert for signs that the market is detecting signals of a sharp tapering off of U.S. economic growth and corporate profits into 2019, at a time when the Federal Reserve seems intent on raising interest rates a few more times through next year. The mini-market panic runs counter to an immediate sense of optimism about a sturdy economy and third-quarter earnings growth of 20%. The fact that the stock market tends to lead changes in the economic trend has heightened Wall Street's anxiety, and yet it's also true that stocks experience nasty pullbacks far more often than the economy skids toward a recession. If there's any bright side of the S&P being at risk of breaking its 32-month uptrend, it's that the selling has reached a short-term extreme that frequently precedes a very strong bounce. With 3/4 of all large stocks down more than 10% from their high and nearly half off at least 20%, a lot of damage has already been done. This suggests that any reassuring evidence on the durability of economic growth, a let-up in the Fed's tightening pace, or perhaps simply the passage of the election could be enough to propel at least a strong relief rally before too long. For Nightly Business Report, I'm Mike Santola.
So with more earnings on deck, the employment report out on Friday, the midterm elections next week. What should investors be watching? Joining us tonight for a strategy session is Cliff Hodge. He's Director of Investments at Cornerstone Wealth. Cliff, good to see you. Thanks for joining us.
Thank you for having me. It's great to be with you this evening.
For you, this week will be about earnings. You're looking at Facebook and Apple, among others. But what about the fact that the market this month has treated good news still as bad news? They've sold off even on positive earnings reports.
Well, it's a great question, and really there are two key things that I'm watching this week: earnings and jobs. So we do have a slew of earnings reports this week from bellwether stocks and big cap tech names, which, if we get any sort of good news, can go a long way toward turning the tide with this negative sentiment that we've had over the past month.
So I think you just heard Mike Santoli's report. One house on the street thinks that basically we're going to morph into a bear market. The other thinks that everything's overdone. Where do you stand on that debate, given some of the hurdles that the market still has ahead of it?
Sure, and that's the really important question that investors are grappling with. When you look historically, whenever we have had these sell-offs that are not accompanied by a recession, they've gone on to be great buying opportunities. And while I'm not ready to call the bottom just yet, none of the recession indicators that I watch are flashing yellow or red at this point. Mm-hmm. So I think ultimately we will go on to make new highs before the economic expansion and this bull market ultimately come to an end.
What about jobs on Friday? The last few reports have been okay, not home runs, but okay numbers, and enough to keep the Fed on track to raise rates some more. Do you think that'll happen on Friday as well?
Sure. So the jobs number on Friday is the most important number going into the midterms. And while the headline unemployment number will garner most of the attention, I'm actually going to be more focused on wage growth. So the market is forecasting an hourly average earnings increase of 3.2% year over year. I think anything less than that will actually be a positive for the stock market, because it'll be an additional data point that may cause the Fed to hike going forward.
You said you weren't
ready.
Go ahead.
I'm sorry. I think an overly aggressive Fed is the number one concern for markets going forward.
Very quickly, once the midterms are over, is that a green light for the market? The market always hates uncertainty.
The market does hate uncertainty, and you never want to say never. But when you look back historically since 1950, U.S. stocks have never had a price decline 12 months after midterms. And the average annual return of the S&P 500 over that same time span is over 15%. So in my mind, history is certainly on the side of the bulls going forward.
All right, very good. A bullish Cliff Hodge joining us tonight from Cornerstone Wealth. Thanks for joining us, Cliff.
Investors fled from actively managed funds, which suffered their worst quarter in 7 years. According to the Financial Times, more than $86 billion was pulled from stock-picking funds globally in the third quarter, just as volatility started to pick up. Active funds have been losing market share to passive funds for years.
And not even a massive technology deal could make investors optimistic today. As you've probably have heard by now, IBM confirmed this morning it is acquiring software and services firm Red Hat for $33 billion. That is the third largest tech takeover ever. The purchase gives IBM a bigger presence in the cloud, but it's paying a big premium for it as well. Shares of the Dow component fell slightly, while Red Hat stock soared by 45% today. And even as IBM touts the benefits of the deal, there are still plenty of questions to be answered. Josh Lipton has details.
IBM CEO Ginni Rometty just made her biggest bet yet on the cloud, calling the acquisition of Red Hat transformative.
For us, it's all about resetting the cloud landscape. And this is to create the #1 company that will be the #1 hybrid cloud provider.
IBM's strategy is to capitalize on the market for what's known as hybrid cloud computing, where Red Hat is a big player. That's where companies store some data in the public cloud, like Amazon's AWS and Microsoft's Azure, and other information in their own private data centers. That's often necessary to do because of regulatory reasons.
You have to be hybrid. You have to be able to handle multiple clouds. You have to be open technologies. You have to do multi-cloud management, and that's what we can do.
Red Hat is the largest distributor of Linux, the popular open source operating system. The company makes money by providing software tools to companies as they build apps and services for the cloud era. So will investors be as excited as Remedy? That remains to be seen. Analysts say this was a fairly expensive acquisition and that it does not address some of IBM's broader challenges.
Despite it being a attractive, compelling, large deal, by far the largest one IBM has ever done, it doesn't solve the core problem that IBM has, or even really make a lot of progress in solving that problem, which is that IBM still has about 40% of revenues in structurally declining areas of enterprise IT, areas that are not coming back.
One more possible challenge, there's plenty of competition for IBM in this market too, from other tech companies like Microsoft, Hewlett-Packard Enterprise, and Dell EMC. For Nightly Business Report, I'm Josh Lipton.
So let's turn now to Orvin Ramnani for the details on the deal and also the outlook overall for IBM. He is the tech analyst at KeyBanc Capital Markets. Orvin, nice to have you here. Welcome.
Hi, Sue. Hi, Bill. Thanks for having me on.
We've heard both sides of this. It's a transformative deal, or they're so far behind it's going to take them a while to integrate this deal and start to compete with Amazon and Microsoft. Which is it in your book?
Look, I mean, IBM and Red Hat, they've been dating for about 20 years. They've been partnering since 1999. So they have a lot of experience working together. They've created a joint product together. They've invested in labs together. So the 20-year-old relationship, I think, has a lot to do with the deal. So while I think it's a fairly large deal, the fact that they've had a long-standing relationship, I think, serves them well in ensuring there's a relatively quick integration.
Okay, so they've been dating a long time, but there are a lot of people on Wall Street who think the wedding was too expensive at $33 billion. They're going to have to make an awful lot of money to get this deal back. What do you think?
Look, I mean, the cloud market is a $1 trillion opportunity, and at $1 trillion, it's still growing. So it's a fairly large opportunity that they're chasing, and potentially it has the potential of changing course for IBM's future. When you look at it in that context, it's actually a small price to pay, given the size of the opportunity and the potential for IBM to change course.
How quickly do they have to integrate these two companies, which have very different cultures, even though they have been dating for a long time? They have to get that integrated fairly quickly, do they not?
They have until late 2019 before the transaction closes, and I'm sure there's going to be a lot of prep work from now until late 2019, and after that they still have a year or two. Given the fact that they've been working together,
right.
I kind of look at it as more for 24 to 36 months roadmap for them.
Before we let you go quickly, what do the competitors do? Anything? Does Amazon, Microsoft, Oracle, anybody else have to do something to respond to this?
Look, I mean, I think, like I mentioned, it's a humongous opportunity. It's a $1 trillion opportunity. I do think there are going to be multiple winners. I don't think this is a winner-take-all situation. With this transaction, basically, IBM is playing more on the private side, on the hybrid side, and I think they have their own spaces to work in.
Orvin, thank you very much. Orvin Ramnani with KeyBanc Capital Markets. Bill?
Great, thank you.
You bet. So investors were watching a number of other stories unfold across the globe. In Germany, for example, Chancellor Angela Merkel, once the most powerful political figure in Europe, said that she will not seek re-election in 2021. That led to a decline in German bunds, but a rally in German stocks as investors believe that Merkel's eventual exit will lead to an easing of austerity measures in that country. And in Brazil, an aggressive proponent of free markets won that country's presidential election over the weekend. And analysts say that Jair Bolsonaro's victory could lead to broad economic reforms and the privatization of some of Latin America's biggest companies.
It is time to take a look at some of today's upgrades and downgrades. Ford was upgraded to buy from neutral at Goldman Sachs. The analyst cites the company's restructuring plan and the rollout of new models. The price target is $12. The stock rose 3% to $9.28. Electronic Arts was downgraded to sector weight from overweight at KeyBank. The analyst cites concerns over the company's pipeline. The firm expects downward revisions to the company's earnings estimates, and the stock fell 5% to $91.19.
Meanwhile, Apple was given a buy rating in new coverage over at Jefferies. The analyst there says that Apple can build a massive services operation from its core iPhone business. Price target now $265. That stock fell more than 1% to $212.24. Ralph Lauren was rated a buy in new coverage at Deutsche Bank. The analyst says that the apparel maker is, in his view, in the early stages of a brand turnaround. Price target $149. That stock rose more than 2% today to $130.88.
Still ahead, China's bridge over troubled waters. The Commerce Department will restrict American companies from selling goods to a Chinese state-owned chipmaker. The government cites national security grounds. The move is a blow to the Chinese company, which relies on U.S. technology for production and which Micron Technologies recently accused of stealing its intellectual property.
Well, a common theme in many companies' earnings calls this quarter has been trade. And according to CNBC, 35% of the conference calls that took place through last Friday mentioned tariffs. 45 companies, including Harley-Davidson and Costco, said that tariffs were having some negative impact on their business, while 5 companies, including Kansas City Southern and CarMax, said tariffs actually helped their results as customers pulled business forward to beat out the economic impact.
And with reports that the U.S. is planning more tariffs, U.S. businesses already caught in the middle of the trade war are hoping to win exemptions. But so far, that has not been the case. Ilan Mui is in Washington tonight.
Tariffs are swamping Sea Eagle boats in Port Jefferson, New York. Kayaks, paddles, air pumps, they're all getting hit. And for owner John Hogue, there's no way out.
The annual cost to our company, which is a small family business, will be over $1 million a year.
The Trump administration isn't handing out any waivers from the latest round of tariffs on $200 billion in Chinese goods. And businesses say that's not fair.
The exemption process, it provides them an opportunity to hear from stakeholders about what those impacts are and to remove products for which there is no alternative source for.
Retailers are pushing back in a new letter to the White House. They want an escape hatch before the tariffs jump from 10% to 25% in January. And they've got support from a bipartisan group of lawmakers. But critics say big business shouldn't get any favors from Uncle Sam.
Whenever you have a high tariff situation, you have everyone trying to game the system, and you have a high propensity for cronyism and corruption.
Companies have been able to apply for waivers before. The government was overwhelmed with nearly 50,000 requests for exemptions from tariffs on foreign steel and aluminum. Officials are still working through almost 7,000 petitions from businesses trying to avoid previous tariffs on Chinese imports. This time, there's no emergency exit. Hogue says higher costs will mean higher prices for his customers.
Tariffs will not save any American jobs in manufacturing. They will only hurt jobs in distribution, in sales, in marketing, in IT. They are a completely destructive effort in this industry.
He hopes Sea Eagle can ride out the storm. For Nightly Business Report, I'm Ilan Mui in Washington.
And there are reports tonight that a Chinese regulator wants to cut the tax that's levied on cars purchased in China by half. According to Bloomberg, the move would relieve some of the pain caused by the escalating trade war, which threatens to affect demand for vehicles over there and slow the Chinese economy more broadly. China, as you may know, is the world's biggest automobile market and a key battleground for GM and Toyota.
To keep its economy growing, China is making a big investment in infrastructure and the world's longest sea crossing in particular. But as Eunice Yoon reports, that bridge has been surrounded by controversy.
Behind me is the world's longest sea crossing. At 34 miles, it's now the 6th longest in the world. The bridge used up 4.5 times the amount of steel needed for the Golden Gate Bridge, and it has a 4-mile sea tunnel in the middle to avoid some of the busiest shipping lanes. The purpose of the bridge is to more directly connect one of the world's richest cities, Hong Kong, to the manufacturing area in the Pearl River Delta. This region has been the driver of Chinese manufacturing, and the idea is to make it easier to move people and goods around. The bridge is meant to cut travel time from where I am now in Zhuhai to Hong Kong from 3 hours to just 30 minutes. President Xi Jinping was here for the opening ceremony. It was unusually low-key considering the scale of the project, perhaps because the project hasn't been wildly popular, especially in Hong Kong. The bridge has been expensive. Officially, there's no tally, but state media has put it as high as $20 billion. The bridge has also become symbolic of the growing entanglement between Hong Kong and mainland China. There's a feeling in Hong Kong that China is encroaching on the city's one country, two systems governing framework. One lawmaker described the bridge as an umbilical cord, a reminder of Hong Kong's ties to the motherland. For Nightly Business Report, I'm Eunice Yoon in Zhuhai.
Bloomin' Brands sees a good year ahead, and that's where we begin tonight's Market Focus. The owner of Outback Steakhouse and other restaurant chains reported an increase in customer traffic as well as growth in comparable U.S. sales. And as a result, the company increased its profit and sales guidance for the whole year. Shares rose nearly 2% today to $19.15. HSBC reported better than expected profit in its third quarter. The biggest European bank said it benefited from stronger business in Asia as well as from cost controls. HSBC shares were up nearly 4% today to $40.18.
First Data missed earnings estimates and cut its full-year profit forecast. The payment processing company says it is facing headwinds from the negative impact of currency fluctuations. And so First Data shares took a beating today. They fell 16% to $18.01. And after the bell, Mondelez said strength in its foreign markets helped earnings edge past expectations. The maker of Oreos and Sour Patch Kids also reported a rise in sales, but those results came in shy of estimates. Shares were volatile in the after hours, but they finished the regular day unchanged at $40.11.
Coming up, is the entertainment industry getting any closer to closing the gender gap?
When it comes to gender equality, a new survey has found that the country's entertainment industry still has a long way to go. Julia Borston is in Los Angeles with the details.
After a year marked by the Time's Up and Me Too movements and high-profile firings of men for misconduct across the entertainment industry, Hollywood still has a long way to go to get to equal. Both men and women working in entertainment see gender gaps in the industry, according to a LinkedIn CNBC survey of over 1,000 people. Even though equal pay is mandated by law, about a quarter of women and about half of men say they think men and women in the same roles are paid the same. Slightly more than that say men and women are promoted at equal rates.
I'm not surprised. And look, I think you've had immense structural bias in our companies. I don't think it's always intentional. I think there's deep unconscious bias.
Sarah Hardin is the CEO of Hello Sunshine, a production company founded by Reese Witherspoon to focus on female-driven content.
Me Too and Time's Up have opened up a conversation to shine a light on that bias and say, look around, we have to do better.
There are obstacles in place that make it challenging for women to advance, according to 80% of women and more than half of men we surveyed. The biggest issue, an unsupportive or biased corporate culture. Other challenges include a lack of female leadership and mentorship. So what will it take to close the gap in entertainment? The single most important thing is for industry leaders to speak out about the importance of diversity and inclusion in the workplace. Also considered key, a focus on diversity in recruiting and casting. At Hello Sunshine, the mission is to put women at the center of every story. Their female-dominated team is producing for every platform: TV, film, streaming video, podcasts, and audiobooks. And Hello Sunshine's Hardin says she thinks the traditional entertainment giants will understand the value of embracing diversity.
I think the best companies will realize that their economic futures, that they need to bring women into authorship at all levels of their companies, whether it's their boardrooms, whether it's their writers' rooms, whether it's their meeting rooms, if they want to produce any product or service that is looking to connect with women.
With companies like Hello Sunshine striking deals across the industry, our survey found widespread optimism that the industry will shift towards equal representation. 2/3 of men and women saying they expect the Time's Up and Me Too movements to have a lasting effect. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And before we go, a final look at the day on Wall Street. Another wild one. The Dow was down 245 points. The Nasdaq slipped by 116. The S&P was down 17. And given this volatile market stretch, we all need a reminder sometimes about what to do and what not to do. So tonight, we leave you with a piece of advice from the CEO of Charles Schwab.
The most important thing at a time like this is either to do nothing, stick with your plan, or if things have changed for you personally, update your plan and change your investment approach to reflect that. But don't make changes based on what the market happens to be doing today, tomorrow, last week, or next week. That's a sure losing strategy.
Words to live by, right? That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.